Hey traders, welcome to Charts and Coffee. Happy Friday, everybody. Hope everyone is doing well with a nice big mug of coffee or tea or mate or whatever it is you get your morning started with. Thanks for being here. Let's get to it, gang. We have Opex on tap today. So on top of all the volatility that we've been seeing, the main message has been for me this. We were dominated by a lot of Skynet algos in this area. Humans are back. Humans are back. Look, humans are going to take a break from time to time when the environment is confusing, uncertain, when the messaging isn't clear. And that's what we've had. And as much as geopolitics or OPEX or earnings or anything could be part of, and I do think it's absolutely part of what the volatility has been that we've been experiencing, most of this is a very systematic letdown of the Federal Reserve not clarifying their message and additionally pushing rate cut expectations further and further and further out into the year. Now that is a letdown, right? That is a letdown because if we look back to when the bond markets, let's take a look at, for example, TLT. When the bond markets made their big move, now this is not really the big move in the bond market. The one that I'm talking about is the one that's being taken back. This was the move back in late October to early November, where if we think about a 3 to 6 month sort of lead time, where bond traders are thinking rates will be likely lower come the end of Q1 or the beginning of Q2, which was largely the expectation for a prolonged period of time, yields went down. And it's inverse directionally. So TLT moves up, but yields move down. So here's another way to look at it. Let's say you're looking at the 10-year. So a lot of folks might look at the ZN, that's the futures contract that we would trade. And you see how between mid-October to about mid-December, almost late December, yields went, well, I'll show you how that looks. Yields went down. So TNX is another way to look at it. I don't look at TNX all that much. I usually like to look at IEF. That's an ETF you could actually trade, but yields went down. Now they're going back up again. Why? Because the expectations are not panning out. So they have to readjust, look back out 3 to 6 months. And now it's looking like September. Are the rate cut? Yeah. What is it now? What's that symbol? It's changed. TNX doesn't work on TOS anymore. Yeah. Someone told me about that. I don't look at TNX all that often. Is it on? There we go. So you can look at the TNX on TradingView. And this is when yields were moving down and now they're moving back up again. So it's an inverse relationship, by the way, gang. And what does that mean? Again, bonds move up when yields move down. And so that's where we sit right now. Bonds hate this. Now, please don't think, we were talking about this earlier in the mastery or in the Simpler Central room. I don't recall which one, but we were having a discussion about bonds. Do bonds matter? They matter to bonds, right? They matter to the expectations about yields. So here's where I want everyone to just take a look. Don't take my word for it. Always go back to the data. What could data be? Price. Take a look at the S&P. And look, I love this view. I love this view. If you take a look at the S&P April to April, so 12 months back, what has the trend been? It's been up, right? So if bonds were the ones telling us what was happening, what to do, because, oh my gosh, if bonds are heading to higher yields, that's, no good for equities. Not true. So please, 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 there's a lot of things that get repeated, but they're not necessarily true. So no more than when I was, buying since end of Q3, Q4, Q1, buying the equities, S&P, NASDAQ, tech, semiconductors, financials, right? All those moved up as bond yields were moving up. Well, isn't that not supposed to happen? It does happen. I'll give you another example. Well, Rag, what about the dollar? We keep hearing that if the dollar is moving up, then that's no good for equities either. For those of you that want to take the best look at the dollar possible, take a look at 6E. For our Forex traders, look at Euro US. This is an inverse correlation to the dollar. So hang with me one sec. If the dollar being strong was no good for equities, the positive correlation, the two markets that should move together should be the euro and equities, because euro strength is actually dollar weakness. And where is the euro going? Absolutely nowhere. There were periods of time where the dollar was strong, right? There were periods of time where the dollar was weak. There were periods of time where the dollar was strong. Look at the dollar strength from the end of December to basically now. If we think about Q1, and that was all this dollar strength in Q1, where my cursor's moving, the equity markets were making all-time highs. So remember, it's not that the dollar affects the indices. It's not that the bonds affect indices. So Rag, what is it? It's monetary policy. So think of it this way. The equities are over here, and the bonds and the dollar are over here, and kind of above them is monetary policy. And when monetary policy is suggesting that we're going to see lower yields, the bonds then will move to lower yields and equities will move up. So it's not that they're connected to each other. They have a common catalyst. So please don't get too wrapped up in what bonds are doing. Bonds are telling a bond story. Equities are telling an equity story related to the monetary policy, which is their common catalyst. So think about that. Don't get, kind of turned around and miss opportunities like this, right? This gorgeous uptrend we had in Q1 and think, oh, well, bonds were telling us that. They were 5 months behind, if that was really the case. And that was 5 months of missed profit within the context of a gorgeous uptrend. So I don't want people missing out on those windows of opportunity, which will open and close to grow accounts. Right now, is this a great account growth period? No, it's not. However, trends will resume. And if it's a downtrend, no problem. We can trade it. We're traders, right? We don't care if it's going up, it's going down. We're nimble. We can buy puts. We can buy calls. All right. We can take advantage of a bearish trend as well as a bullish trend. So Rag, why is it so hard right now? Because we don't have a trend. And because we had some of the most consistent above historical volatility price action for a prolonged period of time between the 4th and the 12th. And now, as I like to say, humans are back and we're seeing some direction. Ultimately, though, we're still in chop. And if anything, we're starting to see this as of the 17th. We were in the oversold zone of this chop. So be careful here committing to shorting at lower lows. I mean, unless you hate your money, in which case I'd say pick a charity. Wall Street is not one. I know. Who knew? So ultimately, that's what we have right now. And then here we motor into Opex. Now, I will tell you, the first 19 days of April, from about the 4th to now, have been challenging. I'm sure some folks are doing fine, and congrats, but they've been challenging to a vast majority of traders, frankly, including myself. I had accounts doubling, not only for myself, but members in the mastery in Q1, because that's the environment that we can build accounts in beautifully. This is not one. So what do we do now? Shorten the time frame, shorter term swings, or we kind of increase the number of filters. What are the criteria that we would want to see valid in order to put on a trade? And as we increase those filters, just like a water filter takes more things out, right? That's what we're doing. We're naturally filtering out potential opportunities until either the trends resume, or it turns into a downtrend, or we get past Opex. So I'll tell you this, I'm very optimistic about the last week, about the last 7 days of trading. So from the 22nd to the 30th, I'm very optimistic about some clarity coming back. Let's get through this odd little bubble of action called Opex, where we're going to have interesting movement related to open interest and max pain. Now, yesterday in our bonus session for the top tier outlook, which by the way, you can still join us. You can head on over to, I think I'll make sure that top tier pro class gets you to the offer, but it still does. You can go to toptierproclass.com. But the bottom line is this: once we get past Opex and the humans are back, and we have now a handful of sessions that seem to be perhaps moving within normal volatility ranges. Today, I'm going to expect high volatility today, but we expect high volatility on Opex, right? That's not a surprise. So today I'm going to expect high volatility. And then come Monday, as we wrap up April, there could be some really good trading for the last 7 trading days of the month. All right, so that's where we sit. Talked about bonds, talked about dollars. It is not, bonds and dollars are not taking the equity indices for a walk. I think a lot of folks think of that as the dog and dog walker. Not the case. What's happening? Well, what happened to the S&P? We know that tech's been struggling, and then earnings season has not been kind to financials. And if it's not been kind to financials, it's not been kind to the S&P, and it's not been kind to the Dow. That's where they're waiting for financials. Think Berkshire, JP Morgan, Bank of America, Wells Fargo, etc. Until we get past that little window of the earnings releases, it's going to be difficult to determine whether or not the S&P can move higher. But there are trends out there. They're just not in the places that we have normally looked, right? Gold, miners. I should say gold miners, metals and mining. We also have some decent clarity. Decent. It's not as good as it was, but it's still there in crude oil. So that means we have good liquidity and clarity in things like the XLE, in XOP, in XOM. Now, crude has been a little volatile as of late. And when I take a look at the crude oil daily time frame today, whoa. So crude, heads up, gang. It's Opex. We should be treating this as a caution day anyway. But look at that move on crude. I don't know what that is, but that's way beyond the historical volatility. Do I need to see the news? No. Am I going to presume it's either geopolitics or OPEC or not OPEX, OPEC, another O, OPEC? Yeah, I'm going to presume it's something like that. I don't need to know the news. All I do know, and the most important thing is, this is moving in a way that's outside its normal behavior. That's what volatility does. Volatility lets us know, hey, is this working with a normal price action? As it has for a prolonged period of time. Today, crude oil is having a moment. Let's just let it simmer down. We can re-engage crude next week. So as always, gang, if you have any questions, feel free to ask. Feel free to type them on in. Let's go ahead and take a look at our questions this morning. And let's see. And so I appreciate that, Richard. Thank you. I appreciate that. I think that when I have noticed, when I have doubts about what's going on, I'm just going to go back to my charts. I'm going to go back to measuring all the things we know and don't know about a market. And price is going to reflect that. So, when we look at geopolitics, when we look at, and by the way, I know there's a lot of geopolitical tension going on, but crude has not yet really responded in an above average way, even though this was something that we were dealing with even a week ago. So certainly this is going to be geopolitics, and don't underestimate OPEC. But I think when you look at something like this, yeah, probably a geopolitical reaction. And again, what's most notable is up until now, even with that geopolitical narrative already running in the news cycle, already happening, crude's been able to handle it pretty well until now. There's your warning. What else do we have here today? Questions? All right. Yeah, Richard mentions, there you go, geopolitics. So, there is a lot of volatility with OPEC as well. There's a lot of volatility with Opex as well. So now add all those together, perfect storm, right? We've got OPEC messaging, we've got Opex, and then now we've got geopolitics. They come together. This is a marky mark perfect storm market. All right. So what are my expectations for Netflix today? Well, let's take a look at what we've got. So Netflix is an earnings conversation. I don't engage in earnings. I'll let earnings happen. Do I have expectations, Judy? I'll be straight up. Don't know, don't care, don't trade it. Think about what Netflix has been doing up until it went highly volatile. That was the 15th. And now we're going into earnings. So this is just a difference in what part of the calendar is most useful to different traders. If a trader wants to trade earnings, I don't. Today is, obviously going to be a reaction to that. But let me ask everybody just for a moment, from earnings to earnings, in between, did we not have mostly an uptrend? So I would rather take advantage of the window, not earnings. To me, that window for trading closes with earnings, opens up after and in between. Look at how gorgeous this trend was. Green meets the gray, green meets the gray, green meets the gray. I'd rather trade that, Judy. So it's not a matter of whether or not you should. It's just, my telling you that I really don't want to engage in earnings. And I don't want to put on sort of this binary big loss, big win, kind of a lottery scratch off ticket type approach to what is likely to be. I mean, look at this previous earnings. I know that move, it looks so appealing. I know that trying to grow an account with that kind of outsized move is very appealing. But for me, it's the boring stuff that builds accounts. It's the nice gradual uptrend that grows an account. And more importantly, it allows me to control risk in a better way. So that's what I'm looking at there. Thank you for the question, Judy. Next up is what is happening with Morgan. Sure. So remember, Morgan is in that window of earnings, but this is what's cool about Morgan. Earnings are now in the rear view mirror. Perfect. I'm not dealing with earnings coming up, and we can see some of the reaction in front of earnings. And remember, some of what happened with Morgan is a reaction. See this move on the 11th? Let's go to some of the larger weighted names in XLF, other earnings that came out before Morgan. See that there? That gap was JP Morgan. So Morgan, a lot of times, and other smaller weighted stocks in that sector are going to they end up ultimately getting swept up in that narrative of a larger big bank in the XLF releasing earnings. That said, now what do I want to do? I'll tell you, of all the things that I could do with Morgan, this is ultimately now a choppy environment. So here's what we can do. Split the range in half, and then split that range in half again. So now we're looking at the bottom quarter of the chop that's defined by the Darvis. That bottom quarter is where I want to engage long calls. Why long calls? We're still above the equator, right? We're still above that 200. And that makes a big difference. Is healthcare defensive in this market? Sean, I don't believe healthcare is, in my experience, I would not say as a general rule, healthcare is defensive. Healthcare is moving with the weakness that we're seeing in the Dow and in the S&P. In fact, healthcare has been weaker sooner than those. So not in any way, no, would I consider healthcare defensive. In fact, there's very little corners of the market right now that are. Normally, we would look at XLU, XLP, and they have not been moving in a way where, what does that mean to be defensive, right? If flows, say in the S&P, are not suggesting higher highs, where do we go to withstand the volatility or the weakness? Where do we go where we would expect a little bit of a return? It's not been the typical, the places like utilities and staples. So I don't see defensive action necessarily happening. And I try not to trade in a way that prioritizes that. So that's another thing. What I will say is I'm always going to seek out trends. I'm always going to seek out flows. And that means ultimately, where are the trends? Miners, gold miners, metals and mining, and really still hanging on there pretty well. Energy. But remember, XLE is going to be subjected to what's going to happen in Exxon and Chevron for their earnings. So be aware of that. Question here is quad witching and Opex the same? So thank you for the question, Richard. Quad witching really is not a true term anymore because we really don't have four things expiring. There was something called stock futures that would be the quad part of quad witching. That's not really even a thing. So it's always triple. And triple witching is the quarterly third Friday of the month. So the third Friday of March, third Friday of June, third Friday of September, third Friday of December. Opex, and thank you for the question, Richard. Opex is simply the third Friday of every month. And when that third Friday of every month is also a quarterly, right? So back to March, June, September, December, then it's that triple witching. Lots of things are expiring, futures contracts, options, etc. So it's just a heightened version of the third Friday of the month action. All right, so that's Morgan. That's the way I would treat Morgan. And yes, we have some geopolitics. Will we have a caution day next week with a PCE? William, I'll likely have a bonus session in the Sector Secrets Mastery. So again, if anyone wants to join us in the Mastery, we do a mix of a lot of things. We trend follow. We focus on sectors. We focus on macroeconomics and futures. And if you want to see how we can look at futures on a PCE, or even if you don't want to trade the futures in a volatile environment like that, we can look at the macroeconomic sort of punchline that we will see when the Federal Reserve's pet inflation gauge lets us know what's happening. That could be a massive shift either more dovish or less dovish in terms of expectations for the remainder, at least of summer. All right, gang, as always, thank you so much for being here for Charts and Coffee. We'll be back on Sunday for our 6 p.m. Eastern Top Tier Outlook show. And then I'll see you right back here in Charts and Coffee on Monday. Same time, same station. All right, gang, be good to each other. I'll talk with you soon.